everybody. Welcome back. It's been a minute, but I got a real special treat for you guys. We are getting a new protocol for some new functionality added on top of Hex. So that's pretty exciting, if I do say so myself. I got C3 Works and RJ in the green room right now. Going to bring them up in just a second to talk about the Actuator, but it's a protocol I'm pretty excited about. It's going to give us some extra liquidity to our Hex stakes. And I think even more interesting to me, it's the first protocol that's utilized HSIs to build on top of Hex. So, we had Alex create the HSIs to be able to allow us to wrap our Hex stakes, which is a big step forward from a technical standpoint, from a technical standpoint to build on top of Hex. But what was most exciting about the HSIs is that by allowing to wrap Hex into HSIs, into NFTs more specifically, that would have allowed other people to build on Hex in a more interesting way. And this is the first iteration that I have seen of that. So this is going to be a fun stream. They got a nice presentation for us. They're great guys. They asked to give my opinion on the stuff quite a few months ago. So it's cool to see this project coming to fruition. But real quick, we'll just say hi to everybody in the chat. Red Squirrel, what's up? Alex Santos, good to see you again, buddy. Crypto Kid, Luke Duke, Black Label Expat, what's up, man? And we got Fast Abdul. All right, everybody, let's bring them up. What's up, guys?
Hey.
Microsoft. Hey, how's it going? I'm doing great. Thanks for hopping on stream and talking to my audience about what you guys got cooking.
Yes. We've been looking forward to this one for a while. You gave us some key advice, like you said, in the earlier days of our protocol. So we're grateful and we're excited.
Of course, I saw your guys' stream with Hexray Vision, and when I was just watching through, I saw you guys implemented a couple of the things that we talked about. So that made me happy. I was glad to hear that the advice was actually helpful and not just a waste of time for you guys.
We weren't kidding. It was. And also the Forge has been a big help too, that you initially forwarded us onto them, and they've been really great and just incubating us, to the point where we're getting ready to launch here. So
I'll have to go on there and leave a review for your guys' protocol, so you get you guys some engagement.
Thanks. Yeah, appreciate it.
Yeah.
Yeah, well, why don't you guys start? Just introduce yourselves, tell us about yourselves, your background, and then we'll get into the finer details.
Yeah, you bet. Maybe I'll start us off here. C3 Works, I go by Bill as well. You can call me that. A little bit of background about the first half of my professional career was in the U.S. Navy Nuclear Submarine Force. So a lot of technology, a lot of engineering, and all things tech in nature. And then the second half following that was in the U.S. securities and investment banking business. So specifically in fixed income, bonds, a lot of risk management, a lot of analytics and market research, obviously dealing with a lot of regulations, all the things that go with U.S. securities. So I was on Wall Street in the middle of the bond business during the 2008 financial crisis as a managing director, running circumstances in the middle of sales and trading and fixed income when all that collapsed and train wrecked. And it was coming out of that on the other side of that personally, where having seen how the sausage is made, I was growing very disillusioned with what got us there, Federal Reserve, and what was happening afterwards, Federal Reserve, with respect to QE, 1, 2, twist, 3, infinity is what we're at this point. And so it didn't take too long after 08 that I began to say, I think I need to chart a course out of this because we got a problem in the global financial system. About 2013 into early 14, I stumbled across Bitcoin. Like all of us, the first time I see that, I'm thinking to myself, there's probably nothing here. 4 months later, there's something here. And so aggressively moving through, that was the beginning of my Bitcoin and crypto world. But I still had 3 more years before I could carve myself into retiring out of the investment banking business, which occurred in 17. Right around the time I met RJ and we began to do some things. So we'll give his story. And I've been full-time crypto ever since 17, done mining of Ethereum, done all kinds of different things in the crypto space along the way, survived all the crazy stuff in those early days, DAO hacks, all the things that you can step on. So at this point, I'm involved in a capital management business. I'm also involved in, of course, this protocol with RJ, and very immersed in all things crypto. So with that, I'll pass it to RJ.
Yeah, thanks, Phil. So yeah, I have a different path that took me right here. I've been writing software for about 10 years. I too, though, came from the traditional finance space, writing enterprise software for clients, for research and analytics, building dashboards and chart builders and all that kind of fun stuff. And yeah, I was kind of set up on a successful trajectory in traditional finance, and that was all I knew. And then I got introduced to my co-founder here, C3 Works, and so he was my first exposure, like 6 or 7 years ago now, to crypto. And I was kind of intrigued at first, but then eventually I was like, yeah, I don't think this guy's right. I didn't believe him, thought it was kind of silly, and then I walked away. I think you might have even offered me a full-time job at one point, and I said no to that offer. I went back to TradFi. I kind of got more successful there, and then it started to become clear to me, that at least from the technology perspective, it's such a mess, like the fracturedness of all the financial data in TradFi, and nothing has like what we call a primary key. There is no like common primary key. It's such a mess. And it just became so clear that there's crypto is the better implementation of finance. And I know that became especially clear when my co-founder here recommended me a book on writing smart contracts in Solidity. And I went through that book, and really had a lot of aha moments there. And then eventually, I was kind of consumed by a lot of just all the exciting things happening in crypto. And so I went to work full time here with my co-founder, and we've been building a lot of internal tools that are pulse chain related and just general investment tools. And yeah, so that's how we eventually crossed paths and we went full time together. And then we started, started listening to some of your content, Crypto Sloth, in the time of the HSI and the Hedron and Icosa launch, and yeah, we benefited a lot from your analysis, and we even built our own dashboards for in those auctions to get
probably better than mine.
Well, we had a lot of fun. What we realized though is what we really needed was just automated bots. But we were able to break the data down in some cool ways. But then eventually that kind of dried up, and there was a gap in the market there that we wanted to solve. So that's kind of the genesis of our project.
Yeah, no, it's a great background. Thanks, guys. It's always nice to see people from traditional finance kind of in our ecosystem, because I feel you guys give a really grounded perspective on what's going on, and also can relate things back to what has traditionally worked. Just before we dive into everything, I'm curious, a lot of times what you find with people to getting into like the Hex community, there's a couple like splits that happen along the way. The first one is like crypto or not. Like some people they're like, nope, crypto's not interesting, whole thing's a scam, don't want anything to do with it. But if you go down the crypto road, then you get like to the Hex stuff, and you're like, nope, that's a scam, not. Or like you say, like, yeah, like this stuff is pretty cool. Like talk us through a little bit about your guys' journey to like mentally wrapping your head around, the Hex pulse chain ecosystem. I guess more specifically Hex, because that's what the Actuator is about, and like what you saw was valuable about the system.
Yeah, well, why don't I kick off? I ran across Richard Hart's projects and activity in maybe the second quarter of 2019. This was pre-Hex, pre-launch, right? And it was coming in just about the time that I could still tool up for getting involved on day one, which I did. I'm a day one Hexican, a day 30 Hexican. So I bought the top, I bought the bottom, and I bought a lot of stuff along the way. Every day involved in the adoption amplifier, all the things that went with that. But to answer your question, also did the same with the Pulse sacrifice, the PulseX sacrifice. I've been a part of everything Richard Hart's done that I know of since the launch of Hex. what I saw was this. RH was definitely an unusual character. And the first thing I noticed is he was unusually honest. And that was pretty important because, you know, there's a lot of things that can really get you in trouble in crypto. And, you know, folks have different agendas out there, and, you know, that's fine. It's not wrong to try to push whatever it is you're doing, as long as you're doing it without deceit. But in Richard's case, he was brutally honest about everything from Bitcoin to what he was trying to do to the problem he was trying to solve. So that already got my attention. And then to hear the fullness of his ethos, I mean, the ethos, things like trustlessness. You want to have, you know, not your keys, not your coin. Yeah, that goes back to other folks as well, but he embraced that very fully. He was putting forward the kinds of things that would keep people from train wrecking themselves. And his project was oriented, you know, Hex at the time, towards making sure that that could be done, that you could earn yield, that you could stake your own tokens, you'd have control of them. It was permissionless, it was unconfiscatable. You can't go and get hacked as long as you don't give somebody your seed words, which, by the way, never do that. I don't know why people end up wanting to do that, but you don't do that. So I was intrigued at that honesty and him identifying the solutions to what some of that was. Plainly, in some of the traditional crypto areas, you had a lot of projects that were, you know, we can call them scammy, but the fact was they didn't follow these types of things. They were heavily backed, pointed to centralized exchanges. Everything wanted to get back to centralized exchanges. And those should be kind of red flags, or centralized activities. So that's the answer to the question for me. He was honest. I think that's the source of a lot of gatekeeping personally. Why is he facing so much gatekeeping? Because he speaks such honesty about the kinds of centralized activities in media and in exchanges and in trading activities. And that doesn't work well for a lot of other people's businesses built off that model. They want to make money off of you getting wrecked. And he was the antithesis of that, which I liked.
Oh, that's great. And real quick, I've seen you know, speaking of scams of like people giving away their seed words, I've been noticing comments on my YouTube channel where people are like, "Hey, great video. I have these like 12 words. Can you give me some help with them?" Well, now they're giving away a supposed seed phrase. I'm like, I don't know what that is, but that's obviously a scam, which is gonna block all of those people immediately. I'm not even gonna try. So don't give your seed phrase away. And if you find a seed phrase from some random person in the comment section, don't type it in anywhere. I don't know what's gonna happen, but it can't be anything good. You're not gonna get rich that way.
Anybody asking for him is lying to you.
Yep.
There's no free lunch.
Nope, there's no free lunch. All right, RJ, go ahead, buddy.
Yeah, so I came in, I really, I didn't have really an exposure to the RH ecosystem until my co-founder here. And I didn't really know what I was observing at first, because it just wasn't obvious to me what was going on exactly. Like, cause it's so hard, in those early days, especially as a newbie, like, well, is this legit, or is this going to zero? And I think, ultimately what I see is the biggest, indicators that, you want the test of time. And is the protocol, firstly, is it secure? And once you've passed at least a certain threshold of the test of time, that's a key, indicator for me. And then, I also like to say that, the base layer of all these things, it's all technically Ponzi's, and RH says that too. And so once you see the fact that, the USD, it's essentially, an elaborate Ponzi, you start to see things for what they are. And once you admit the fact that you're looking at Ponzi's everywhere, then you have to ask yourself, okay, what is the best combination of carrots and sticks in a Ponzi? Like, what Ponzi with its combination of carrots and sticks is going to have the most product market fit? What is going to drive the strongest community? And so then that's the other thing, just like the emerging community, I guess, was the other thing that I was like, you can't deny. At the end of the day, it's the layer zero that is in a sense the most important indicator, I think, of a project's utility. And so I think once those things started to come into focus, and then once it was clear the pulse chain was going to be in place for us, and then it's just the continued discouragement of what's happening, in other crypto projects, whether obviously the admin keys, or the just there were aspects that I just like I slowly started to see it. I don't know if I was like I wouldn't say myself I was like a day one Hexakin, but kind of seeing it through my co-founder here, it started to emerge that this is legit, this is for real, and this is not going anywhere. And then I was like, this is worthy of being building off of this kind of innovation.
No, that's great. So why don't we go ahead and get into to what we're all here for? Actuator. I'll let you guys start running the show here. RJ, if you want to share your screen, I'll pull up your slides, and then we can give a brief overview, and then get into all the finer details. And I'll interrupt with questions as I have them.
Sounds good. So yeah, I guess I want to premise like everything I'm about to say with that. I'd say this isn't like just the crazy machinations of mine and C3 Works minds. I think this protocol, I think, is essentially just a product of staring at the Hex protocol long enough. And I think once there's certain things I think start to emerge that become clear, such that I think our protocol was more so discovered than it was invented. Because I think it's a natural outgrowth of what the Hex protocol is designed to do. So that's just want to premise it with that. I wanted to start with a thought exercise, just that we could all kind of collectively think about what would the perfect liquidity solution look like for Hex stakes. I think we've come close in certain areas, but we want no solution thus far has achieved all the points that I'm about to mention. So again, what would this perfect liquidity solution look like on Hex stakes, or the perfect solution to monetizing your Hex stakes? Obviously, you need this solution to be highly liquid if it's going to be a liquidity solution. We have to go from the NFT model to the ERC20 model. It has to be highly tradable, and buyers and sellers has to be easily connectable. We need efficient pricing. This is a key one, where the pricing of whatever token, whatever the liquidity mechanism is, it has to be efficient pricing, or in other words, it has to actually represent the true value of your stake. It can't just be arbitrary. You can't have, when you have strange supply constraints, you get inefficient pricing. You want your stake value to be accurately reflected by the market. You'd want this system to be flexible and instantaneous. So in other words, you shouldn't have to do this on the entirety of your stake. You should be able to do it just on the portion. And then maybe you can exit that liquidity position and regain your full stake. So instant exit and entry, flexible. It shouldn't only apply to certain types of users. This system should be workable with any stake size or length. And it should be reliable. There shouldn't be, periods of liquidity and periods of illiquidity. And then lastly, you'd want it to be fully backed and precise. You can't have, imprecise accounting here. You need precise accounting as to what, the price of your stake is, and it should be fully backed by the value of your stake. I mean, this is maybe an obvious point, but whatever your liquidity solution is, you want it to, the underlying stake should actually be the thing backstopping this liquidity solution. And then just the kind of a side point, we want this to benefit the wider ecosystem. So in other words, we anticipate our protocol dramatically increasing the number, size, and length of stakes in existence. And by extension, it'll take a lot of Hex off the table and put it into longer stakes. So then getting a little more specific about our protocol, it's built on Pulse Chain. We've had a couple of security audits and a financial audit, which we've completed. And the protocol is immutable, no admin keys. We just open sourced it a couple weeks ago, and it's built on Hex. So those are the boring things. As far as what the protocol actually does for you, so as I kind of just hinted, we consider this protocol to be essentially the end game for Hex stake liquidity. This is what we're calling, the definitive and ultimate solution to liquidity for your Hex stakes. And it does this by establishing an efficient and fungible market for your Hex stakes. And then kind of a byproduct of this system is that it's going to enable users to purchase Hex at a discount, essentially, and it's going to be a liquid token that users will be able to do that through. And again, by extension, this is actually going to enable fixed returns in Hex, which that last point, that's kind of this one is not something I don't think we've seen before, or at least not at the scale we're going to do it at, where you're going to be able to lock in a fixed return with no counterparty risk on Hex. Because Hex staking, that would be an example of a non-fixed return where you don't necessarily know, it's an indeterminate return at end day. So those are some highlights. You can ask questions, or I could just jump into the mechanics of the protocol if you want.
Nope, keep on going.
Sweet. So I think it's helpful just to have a quick refresher on Hex staking. A Hex stake has a start and an end day, and a Hex stake has a principal, and a Hex stake has rewards. And so this little chart here I have, the blue represents your principal and the green represents your rewards through time. So each day of your Hex stake, you're going to accrue more and more rewards. In other words, you're going to accrue more underlying Hex in your stake. And this Hex, crucially though, is locked up. It's locked in your stake by design, but it's knowable at any point in time. You could just easily, consult the Hex protocol, and you can make a request for, what is the value of my stake. There's a few more details there, but at the end of the day, you can just call the Hex protocol, find out what was my principal, what was my rewards to date, and you can find the exact Hex value of your stake. Of course, that Hex is locked until you eventually reach end day, when your Hex becomes unlocked and you get the Hex proceeds from your stake. So what we've done is our protocol talks to the Hex protocol, and it discovers, what is the principal in your stake, what are the rewards on your stake. It's going to take that amount, and then it enables you to mint a new type of fungible token backed by that amount. So it's what we're calling the Hex Time Token, because it represents ownership in the underlying Hex within your stake, 1-to-1. But we call it a Hex Time Token because it's not redeemable for your Hex until a period of time passes, or in other words, until your stake actually ends. So this is powerful because you can now represent the underlying Hex, the underlying locked Hex in your protocol in a fungible mechanism, and it's fully backed 1-to-1 by the Hex. Then, as I mentioned, it's going to be fully redeemable, 1-for-1 for the underlying Hex at end stake. And again, I mentioned this protocol should be flexible, and it is, in that you could do it on this bar here you see, your principal plus your rewards. You can mint Hex Time Tokens against any amount of the underlying Hex value, up until it can't exceed though the principal plus rewards, but you could do any amount less than that or up to that. And then each day that passes, you can mint additional Hex Time Tokens against the additional underlying rewards. And additionally, you'll have, you also retain ownership in all future rewards though. So you essentially retain your T-share exposure, while also having the option to liquidate, the portion of your stake that you've accrued to date. So that's kind of the high level. There's more details, but those are the core innovations there. I could pause there. Bill, you can add anything if you feel the need.
No, I think that's does a good job of explaining how the Hex stakes work, how T-shares work enough, and what we're trying to be able to extract. So maybe the HTTs are the place to go next.
Yeah. Got some weird. There we go. So the Hex Time Token, or HTT, as we're calling it, anybody with a Hex stake can mint Hex Time Tokens. So there's no supply constraints. As long as you're prepared to make a stake, you can make Hex Time Tokens. So that's crucial, because we don't want artificially constrained supply here. It should be fluid. And as long as you delegate your stake to the Actuator protocol, you can mint these Hex Time Tokens against it. These Hex Time Tokens, they are ERC20s. They're 100% backed by the stake, and they're going to be liquid, so they're going to trade They're going to trade freely on the open market, or on a PulseX or on any DEX. And again, the amount of Hex Time Tokens that you can create against your stake can never exceed the underlying Hex stake value, which makes sense. You'd break the whole system would break if this point did not hold. So this was actually a point that we brought up to the auditors, is that you can never mint more Hex Time Tokens than you have actual Hex earned or staked in the protocol. And then at end stake, those Hex Time Tokens can be redeemed 1-for-1 for the proceeds, the underlying Hex stake proceeds. And so the Hex Time Tokens, as I mentioned, they're redeemable at end day, and the redemption day can be found in the token information. So you can see it so for example, HTT 3000 is redeemable 1-for-1 for Hex on Hex day 3000. And so each Hex Time token, this will be indicated, in the symbol or icon. And then at the bottom, there's that kind of fundamental formula that we've mentioned, is that what's powerful about the protocol is that one Hex Time token, it's not like backed by some third-party token. It's backed 1-to-1 by Hex. Therefore, it should equal exactly 1 Hex on the day that it's redeemable for Hex.
Let me add this. Another way to think about that is it's a tradable, fungible claim check on a Hex.
Yeah, and you're not subject, unlike maybe other claim tokens, you're not subject to counterparty risk where, is my counterparty actually going to have the underlying asset to deliver to me on redemption day? Well, in this case, that's all enforced by the Hex protocol. So if you trust the Hex protocol, and obviously, we're introducing a new protocol on top of that to, make that redemption mechanism possible. But it's all, at the end of the day, going to be immutable code that's running that redemption process. So there is no counterparty per se that you have to rely on to actually deliver the goods at redemption day. So I have a quick example I could run through here. So this is an example Hex stake, like any other Hex stake. In this example, we have a stake that starts on day 1500 and ends on day 5000. And let's say we staked 1,000 Hex. So if we created this stake and then delegated it to the Actuator protocol, we would have this new function available to you, this minting of Hex Time Tokens, or this extracting of Hex Time Tokens. And so when you've delegated this, in this example, if you've delegated this stake, the moment that you create the stake, you can then immediately extract 1,000 HTT 5000 tokens. So you're able to extract 1,000 Hex Time tokens because that's your principal in this example. And then it's the token that you're minting is HTT 5000 because that's when my underlying stake ends. So those two things would match in this case. And as your stake accrues in underlying interest, you could mint additional Hex Time tokens against that interest. So let's suppose sometime at mid stake, we accrued an additional 100 Hex in interest. That means that our total stake value now is 1,100 Hex, so principal plus interest. And we can extract an additional 100 HTT 5000 tokens because of that additional interest. And then lastly, if we waited till end stake, we could end our stake like any other stake, and we would receive the proceeds minus the amount of Hex Time tokens we minted, because whoever owns the Hex Time tokens has the claim to that amount of proceeds in Hex. So in this case, suppose by end stake, my total stake value ended up being 1,300 Hex. So I had 300 in total interest, and then I had that principal of 1,000. So my total stake value would be 1,300. However, as we mentioned already, I've already extracted 1,100 Hex Time tokens. Therefore, 1,100 Hex is withheld from me, and instead, whoever holds those Hex Time tokens collects the Hex. However, as a staker, I never minted Hex Time tokens against 200. A quantity of 200 Hex is what I get returned to me because I never minted Hex Time tokens against that amount. So it gives you basically precise control over how much of my stake do I want to forego at end stake and instead liquidate now, essentially. And again, whoever owns those Hex Time tokens would have the claim to those proceeds. Bill, do you have anything to add? I don't know. I can keep going. We can talk about the price of Hex Time tokens. That's an interesting topic.
Yeah, the price is where we should probably go next, because what you're going to see, I'm going to give you a read ahead here on this. You're going to find they're all coming at a discount, right? Because if you're going to get something in the future, but you're buying the claim check on it now, you need to be paid to accept that delay. And that comes in the form of a discount. And then the return you're going to get, as RJ will go over, is going to be the price appreciation from what you bought at, what fraction of a hex, up to 1.0 hex, because 1.0 or par, if you were in the bond business, is where the thing's going to mature. So he'll describe that. But what I'm here to highlight as a connect the dots for you, as you begin to consider the yield that's presented by each of these different redemption day spots, you end up generating what's effectively a yield curve in hex as a reserve currency. So those are just some teasers of where this is all going to head. It starts with the mechanics that any given hex staker is choosing to use, but as it develops within the community, we're going to have a whole new set of emergent properties that can support the community in the form of a native yield curve, market-based.
And just as a quick question, do you have slides on like the mechanics behind adding stakes that are plus minus a couple of days from the actual end date in there, or is that something that is that something you'll just later?
Yeah, I think it might be helpful if we hit on that later. I'd bucket that under an advanced topic. It's extremely It's a powerful tool that you have, but I think it's helpful to lay a little more foundation. So
just as a review for everybody, the protocol, most simply put, is you put your HSIs into the protocol around a certain date, and you can mint these HTT tokens 1-for-1 from your principal and whatever interest you've accrued. As you accrue more interest, you can mint more tokens. But if you don't have the tokens on maturation, well, you don't have the hex, because that was your receipt for the underlying rewards and or principal of that thing.
Yeah, well put. So as my co-founder here just kind of alluded to, these Hex Time tokens they're going to trade on at least at start, they're going to trade on PulseX, and they're going to trade on any DEX, and they're going to trade at a discount to Hex, even though they're redeemable 1-for-1 for Hex. And this is where the concept of discount rates come in, which I can't emphasize enough just how much this concept is drilled into you in TradFi. It kind of underpins all financial modeling is thinking about discount rates. So I just want to do a quick kind of refresher on thinking about discount rates. So point number one, just general finance principle. Money received today is worth more than the same amount of money received in the future, all else equal. And this is because if you're going to tie up your money for a period of time, you're going to demand additional return for tying up your money for a period of time. So in other words, in the case of Hex, one Hex today will trade at a higher price than one Hex in the future, if you will. And so said a little differently, one receipt or one claim on one future Hex will trade at a discount to one Hex. And the farther in the future that claim is, or the farther in the future you can exchange, for the underlying Hex, the greater the discount that the market is going to demand. So tying those concepts to our protocol, these Hex Time tokens are essentially the claim on the Hex, and they're going to trade at a discount to Hex. And the longer the time until Hex Time token redemption, the larger the discount to Hex that you're going to see. And then as redemption day approaches on your Hex Time token, as you get closer to redemption day, it'll slowly crawl towards a 1-to-1 ratio between Hex Time token to Hex, which means that shrinking discount represents price appreciation on the Hex Time token. And so as I mentioned here, this would essentially give you a steady, just by simply owning a Hex Time token, you're going to see a steady yield in Hex terms on your Hex Time token as it approaches redemption day until, so this is why you get that fixed return. Because the Hex Time token is going to trade at a discount to Hex. The moment you purchase the Hex Time token, there's going to be some discount rate that you buy at. And whatever that discount rate is that discount rate is going to drop to 0 once redemption day approaches. And that size of the discount is the size of your yield. And so you get this fixed yield that's locked in if you hold the token to redemption day. So here's kind of a chart to demonstrate what the price of a Hex Time token might do in Hex terms. So you can see at the top in this example, one Hex Time token equals 0.2 Hex. So Hex is 5 times more valuable than the Hex Time token. And the reason why it might trade at that ratio is because maybe we have a decade until the Hex Time token is actually redeemable 1-to-1 for Hex. However, as time marches on, you're obviously going to see strange fluctuations in the short term, but the general trend is that one Hex Time token is eventually going to equal 1 Hex. And so you're going to see this this trajectory on your Hex Time tokens, and the farther out the time to redemption on the Hex Time token, the greater the discount the time token is going to trade to relative to Hex. So and thus the greater the fixed rate of return that you could lock in at purchase time. So that's kind of the concept of the discount rate. And then let's build off that to the next concept, which is this yield curve. So said simply, the yield curve is just a collection of discount rates. So those various time tokens that or the Hex Time tokens, there's going to be different time to redemption. There's going to be different redemption days on those Hex Time tokens. Therefore, different Hex Time tokens are going to trade at different discounts. And so the collection of Hex Time tokens is going to establish a curve that gives you, the various discount rates across time. And this is a really powerful concept because, as I mentioned in TradFi, discount rates and then by extension yield curves are underpinning much of what people do in financial modeling. And it's why you hear about yield curves all the time. And yield curves they're super critical because take, for example, the U.S. Treasury market. Basically the collection of U.S. bonds that have different maturity dates. Those are important because they establish a lower bound on the amount of yield you're willing to take, or amount of because they're risk-free in that it's backed by the government. If you have an alternative investment that doesn't have a yield as high as a treasury bond at the same maturity, there's no reason you'd buy that when you could just buy the treasury bond. So it establishes this lower bound, and it tells you basically a lot about what does the baseline of the entire market look like across time. And Hex Time tokens are special because they're going to establish this curve for Hex essentially, and it'll establish a Hex yield curve. And so this is powerful because this doesn't really exist anywhere else in crypto on any chain, as far as I'm concerned. And it's only really possible because of the properties of the Hex protocol. And crypto mentioned what are the interesting properties of Hex that kind of drew us in, and this kind of highlights, this whole project I think highlights what's so fascinating about Hex is that Hex is the only protocol that enables something like this to exist, basically a yield curve on a native crypto asset. And so we think this project is going to kind of highlight, ultimately all the powerful, carrots and sticks that are built into the Hex protocol. This kind of highlights all those concepts. And in addition to that, like we said, we come from the TradFi world. We see this as bringing in a lot of new types of users and adoption into the system, just because you have entirely new strategies that you could deploy when you have a yield curve at your disposal. You could do something what's called a curve trade, which is really common, where one part of the curve you might be believed to be overpriced, and another part you might believe to be underpriced, and you can kind of trade those two things against each other to earn a profit. So but that concept doesn't really exist right now in crypto. You can't really trade one time for another. Like, what does Hex redeemable in 2030 trade relative to Hex redeemable in 2040? We don't really know. We don't have a mechanism in the market to tell us what that ratio should be. But until hopefully once this protocol, once we reach a certain threshold, that information will be revealed to the market. So Bill, do you want to hit on the yield curve?
Yeah, you did a great job, and I appreciate that. The underpinning, as you mentioned, in the U.S. Treasury market, the existence of a yield curve runs on a reserve asset of sort, which is the dollar and its treasuries. In that world, we have a mirror being built with this, with Hex being a reserve asset in this ecosystem of Hex and all that's building on it. That's going to enable a lot of more sophisticated development tools and markets and financial services. I mean, Richard himself has often, well, I say often, but at least occasionally said that if you're going to replace the existing financial system, you have to replace the critical services that it's currently providing. And this underlies a lot of them. So what it becomes is a measure of the risk-free rate of return, risk-free being defined relative to the native reserve asset. In this case, it would be Hex. So we're excited not only for the fact that it opens up liquidity, but it's going to develop a market-based measure of this yield curve on top of which many other things get enabled.
Yeah, and I think it's just important to mention that you just mentioned market-based yield curve, and I just want to underscore that because our protocol isn't the one telling users what the discount rate is on the Hex Time Tokens relative to Hex. The market is going to be the ultimate decider of that based on what they trade, what Hex Time Tokens trade at relative to Hex. So it's going to be all market driven. And again, we don't impose any artificial supply constraints on these. So we're trying to make the protocol such that the market can most fluidly tell us, what does this true yield curve look like on Hex?
That will have a lot of implications in portfolio management. Maybe you have a whole set of stake ladders. Great. But maybe as time goes on, you begin to see what this curve looks like and you begin to assess risks in your portfolio of fixed stakes. Now you have a mechanism to groom that over time. You can just go sell, you could mint and sell the 10-year HTTs and buy up a bunch of open market 5-year HTTs if you felt like that was shaping the risk you wanted to take, for what your outlook is.
Yeah, I was about to say, even if you don't participate in the protocol itself, like directly, the data that you get from the market that comes from the protocol existing is at the very least elucidates some things about like where the market is valuing Hex at different time lengths in the future, and valuing different types of T-shares, because a T-share out for the max is very different than one T-share that ends, in a year from now. So you get to see how the market's valuing all of these things at the same time. And if you see some kind of inefficiency or discrepancy, then you do have the opportunity to profit somehow through it.
That's right. And coming out of institutional fixed income and U.S. securities, where I watched all the time and helped institutional clients trade, sophisticated bond strategies, that how they go about managing risk has everything to do with being able to operate against this kind of a curve. Well, it's clear that this will open up the opportunity to shape risk in your portfolios with either simple strategies or as complex as you might want to get, but you'll have market-based data to do it.
And I want to pause here really quickly before we get into price to bring up a question that I think is important that was brought up about a concern that was brought up a lot during the Hedron days. I have my own particular answer for it, but I want to hear you guys because I think your protocol could get some of the same criticisms. But from the Hedron days, a lot of people were like, well, this kind of breaks the whole delayed gratification model of Hex if you're able to unlock liquidity through selling it for ICOSA or getting minting some Hedron out of it. It kind of goes against some of the central principles of the Hex protocol. And because yours is a protocol that unlocks liquidity, how would you respond to that criticism if somebody brought it to you?
Well, I'll start. To some degree, there's an element of truth in that, right? I mean, I would describe it as saying that's kind of a very blunt instrument, right? When a protocol starts and the protocol is designed to delay gratification, which Hex is, and that's a good thing. And we don't want to ruin that ethos. But so you start by an all or none approach. Nobody can do it under any circumstance. But the fact is, as it develops, if you want it to have market sophistication in the sense of replacing a global financial system, ultimately you need some nuance to that, right? It can't be an all or none. There's no way except to do an emergency end stake, which destroys everything. Consider the types of things that happen in life. We just had I won't name them on the stream. You can if you'd like to, Sloth, but we had a fairly well-known Hex community individual find himself with some difficulty that life threw at him, and had to raise some pretty emergent money for a circumstance that he faced. And if I understand it right, again, I could be wrong on the details, but as I heard the details reported, was faced with having to emergency end stake a pretty lucrative, nice stake that it's financially irresponsible, probably in any other context, to have emergency end stake that kind of a thing. But there was no nuance in a system that's now, 5 years old. And so this would have preserved that. Had this been in place, end stake, emergency end stake wouldn't be the only option he'd have. He'd have a nuanced option to take some capital and access capital and deploy that capital a little more efficiently. Perhaps it's somewhere else in the ecosystem, whatever it might be. So the criticism is, it's not an all or none, or my response to the criticism, as a market develops, it can't stay all or none and expect that it's going to capture the fullness of financial services that a larger ecosystem seeks to become. So we think we're bringing a nuance to this, even while supporting the ethos behind delayed gratification, but it's acknowledging that stuff's going to happen and you'd like to have a fairly graceful way to manage that. That's not irreversible. You can go back and restore it and be right back to where you were after you get through a difficult time. And I think on net, while some will draw liquidity and just dump it or do whatever it is we want to say, on balance, this is also going to promote longer, bigger, and more staking, because people do know that they have some nuance and they're less likely to say, I can't possibly do that because what if?
Yeah, I'll add, that was good. I'll add a couple things. At the end of the day, so for one, like the underlying Hex protocol obviously operates as intended and it's going to continue. And also the protocol doesn't give you access to the Hex. It gives you access on claims. And those claims can only be created on the Hex that you've either already staked or have already earned in the past. So you're not able to mint claims on the Hex, or you're not able to mint these Hex Time Tokens on Hex that hasn't, actually been recorded as earned yet. So I think that's a key point to highlight. And then secondly, like we said, there's no free lunch, which is why there are discount rates. Like you're going to have to accept the market discount rate when you sell the Hex Time Tokens, which is expected, and that's right, because if you convert your Hex stake into present day value that's liquid and fungible, there's gonna be a discount that's enforced, and you're gonna have to take a discount relative to the actual Hex amount in the market. So the market's going to acknowledge that Hex staking is going to yield a lot. Therefore, the discount on these Hex Time Tokens is also going to reflect that. I don't know if that helps, but it's I think it's, yeah, we're not like we don't want users to pull out value. We don't want users to be able to pull out value from the system that hasn't actually been accrued and recorded as earned in the Hex protocol.
Yeah, I'll give. Those are great answers. I'll give mine, and my response to that criticism has always been like, you're wrong. It doesn't break anything. The code does what the code does. The contract only cares that the coins that were locked up stay locked up, and if they're not locked up, there's a penalty. The delayed gratification, while a great concept and was a driving factor in building the protocol, is not technically part of the code, in the sense that the person who clicked the button to start the stakes has to be the one that finishes it out. It's just that stake needs to be finished, serve its time, independent of how it's wrapped amongst different code. So by the technical sense, and what reality is that nothing is being broken in terms of the rules of Hex, because you can't break it. It's what the code does. You can build whatever you want or about it, and if someone doesn't like it, like, too bad, don't use it. Like, I don't know what else to tell you.
Yeah, I mean, the protocol is on this unstoppable march, And the market is also going to continue to build around this protocol. Like there's no stopping that. And then the market is going to tell us, is this protocol, is this valuable? Is this useful? And if those guys are right, then we'll see the protocol will go to zero if they're really right. But I mean, we came at this protocol out of personal need, just because of deficiencies in other protocols. So we know as soon as this protocol goes live, we're going to be the first users. In that, we're obviously going to be providing liquidity. So first users in that case, but also it's just in cases like my co-founder said, where there's just certain life circumstances where you want to preserve that value accretion in your stake, but you also things come up and you want to be able to, or you want to take advantage of other opportunities in the RH ecosystem. Yeah, and I think just to highlight another point my co-founder mentioned was that there's an interesting strategy you can employ when Hex Time tokens are trading at higher prices, where you can actually create a bunch of stakes and then sell for the Hex Time tokens, and then create new stakes. And you can kind of run through this loop here, which is part of what we believe is going to contribute, to ultimately the system creating more stakes for longer and bigger amounts. So.
Here's another general principle, just to add it. A T-share, especially as Hex price continues to go up from here, which it seems to be doing, a T-share is a capital asset. Capital assets need to be treated rightly in an economy. The better an economy treats capital assets, the more capital comes into the economy. And this is an important way to make sure that T-shares as a capital asset is getting treated better and better to attract more overall capital to the space.
Awesome. Well, thanks for going down that side tangent with me, guys. I appreciate it. RJ, I'll let you keep going, buddy. You're doing a great job.
Thanks. All right, so we mentioned that there's going to be discounts on Hex Time tokens. I showed you that curve that is kind of spinning up and down, but eventually trends 1-to-1 with Hex. I think it's worth talking about what exactly is going to drive that discount, like to a more precise level. So obviously we mentioned that time to redemption is going to be a big factor. Longer times to redemption result in larger discounts will be demanded by the market, on the DEX. But I think one really crucial concept to benchmark all of this is what's the Hex stake rate across various time horizons. So we've talked about HTT 3000, HTT 5000. We should ask ourselves, what is the Hex stake rate for a stake created today that ends on day 3000, or started today that ends on day 5000? And we believe that's going to be a really good benchmark to think about what the price of these Hex Time tokens are. In addition, again, just thinking more about price drivers, because Hex Time tokens are liquid, it's going to increase demand on them, just because there's what we call liquidity premium. They're easily you're easily able to trade in and out of them. And the fact that they have fixed returns is also going to be, we think, appealing, obviously, to the market, and it's going to demand higher premium, or in other words, a smaller discount potentially. But back to this concept of the equivalent Hex stake rate. Give me a minute here while I kind of just build up towards this concept. Let's see. So let's think about Hex staking. This chart depicts 3 different stakes. So each dot here represents the 3 different stakes. And this stake, in this case, ends on day 3000, and it's projected to yield 38%. This stake that ends on day 5000 is projected to yield 167%, and this one ends on day 7000, projected 292%. These are what we believe are pretty reasonable projections for stakes, because they're grounded in reality. Like, so the way we came up with these numbers is we looked at the current payout T-share and we projected that through time, and then we said, okay, if we staked 1,000 Hex today and ended on day 3000, we would be projected to earn roughly 38% return, and that's true for these 3 other stakes. So nothing new there, just like pretty base, foundational stuff in projecting Hex stake returns. But to layer on one other chart here, so I just layered on. This is a hypothetical, not a a real chart, this blue one. But this chart represents maybe a hypothetical total yield across various Hex time tokens. And we're looking at how Hex time tokens compare to Hex stakes. So let's look at this example. So this Hex stake, which ends on day 5,000 and yielded 167%. Well, in this case, this particular Hex time token yields 185%. And it has the same time horizon. So we have to ask ourselves, there's a market anomaly here, because there's no reason the Hex time token should have a larger yield than the equivalent Hex stake. So what this means is that the Hex time token is actually trading way too cheaply because it's yielding way too high a return. And in which case we would expect the market, or anybody who could earn, essentially a profit relative to Hex staking, you would instead buy the Hex time token. You drive down the price of the Hex time token, and then thus increase the price of Hex time tokens because you increase demand, and thus drive down the rate of return on the Hex time token and bring it back in line. So it's I think it's going to be an important analysis as the system flourishes, but just understanding, these Hex time tokens, they're backed by Hex stakes, and Hex stakes have, a relatively projectable return. And so we should be able to kind of benchmark the Hex time token discount and say to ourselves whether a given Hex time token discount is reasonable or not based on the equivalent Hex stake rate. So just wanted to highlight that. It'll be an interesting thing to analyze as the system kind of matures.
It's really interesting because buying these HTT tokens at whatever time frame, they don't really give you the benefits of owning the T shares that are out, because the person who has the stakes is the one who's still accruing the yield and has the option to mint the HTT token. But just by looking at the price, you automatically know what returns you're going to get by the end based on like the dollar value that you're putting in. Because if it's like, 0.1, it's at a discount of like 90%, then you're going to get, I guess, a 10x return on the number of Hex that you would have gotten if you just bought them today, like when you go and redeem them. So that being able to calculate that return that you're going to get by buying these tokens and waiting versus just buying Hex off the market and staking it for that period of time, that's the dynamic, I guess, that you use to determine is it better. Should I just stake for this time frame, or should I buy one of these HTT tokens?
Yeah. And interestingly enough, every time you buy a HTT token, you're indirectly putting pressure on the market to create more stakes, because if Hex time tokens get too expensive, the market's going to be compelled to make stakes and mint Hex time tokens and flood with supply to drive that price back down. So we kind of see two sides of the market operating here that both have kind of competing interest, which will help kind of keep the price efficient. And our looks like I can't share my other screens, but our Dapp is gonna make all these tools will be available to kind of just benchmark what's the equivalent staker rate right now versus the Hex time token fixed return, and also we'll give tools to be able to see what's trading at the where do the inefficiencies right now exist in the market, so that users can kind of take advantage of those.
Great.
Go ahead, Bill, if you have anything to add. Otherwise, I can move on to a few other topics, and then we can do some more just general questions.
I would suggest, because in the interest of timing, is that maybe you go over the Actuator token and how that part works so that they see the totality of the project.
Sure. Yeah, I could briefly go through that. So the Actuator token, it's a token to help share revenue that the system generates with the community. And it's got a max supply of 1 billion, and it's going to be deflationary after a period of time. And the token accrues the fees, all fees generated by the system, and the fees come when users mint HTTs or Hex time tokens. So there's a 1% fee, which we see as kind of a sweet spot between, we want minting HTTs to be as frictionless as possible, but we're also want to establish a mechanism for revenue sharing, and so the revenue goes to Actuator token holders essentially. And the mechanics behind the Actuator token, in order to collect that 1% fee, users would vault their Actuator in a particular HTT contract. So whatever HTT you want to earn if I wanted to earn HTT 3000, I'd vault my actuator in the HTT 3000 smart contract. It's just an ERC20 contract, and I'll earn that. I'll earn a pro rata share of the fees that get applied when they're minted. And yeah, so I just mentioned that they're distributed pro rata, and in order to disincentivize, some maybe strange behavior from the system that we want to avoid, we do apply a 90-day lockup period when vaulting. But once the 90-day period has ended, users can withdraw their actuator tokens from the HTT vaults penalty free. And a little bit about the distribution of the token. So 1% of the token at launch is going to go to the Forge, as they've been our incubator. And so the reviewers of our protocol on the Forge website, as well as NFT holders at the Forge, will get a share in that 1%. In the fullness of time, the actuator, our team, is going to get 24% of the token, and 5% initially is allocated to our company account, and we're going to use that for liquidity management to establish the actuator pools at start. And then 75% of the token is distributed through these farming emissions. So users who deposit liquidity into the HTT PulseX pools, they'll be able to collect the actuator token. And so we obviously want most of our token to be distributed to the LPs, to just kind of align incentives between for holders. Yeah, so the farming, as I mentioned, 75% of the token goes to farmers, and this is the distribution schedule of the farm emissions. So we have kind of a linear but each year decreasing distribution of the token, and then we are incentivizing. We're creating incentives across 6 different pools. So Hex Time tokens that end in that are divisible by 1,000 days. So HTT 3,000, 4,000, 5,000, and so on. There'll be users who supply liquidity in those corresponding pools will be able to earn actuator tokens. Quick overview on the actuator token. Pretty much covers it though. We don't want to be overly creative or complex with the actuator token. We want to use it as a bootstrapping liquidity mechanism, as well as a mechanism to share in the revenue of the system.
Nice. So if I'm hearing you correctly, you can't just stake the actuator token and just get flat 1% from the whole protocol. It's the specific HTT contracts that you get the 1% from. So you have to allocate it basically based on which ones you think are going to have the most activity or the most minting from, or the ones that are less competitive. There'll be a whole gaming that whole where to put your actuator tokens.
Yeah, and one good strategy would be, if you're about to mint Hex Time tokens, you should you'll have an inside information there to recollect some of those fees that get enforced. But yeah, there will be probably some kind of an interesting market that emerges around where should users be vaulting.
And let me add one thing on top of this. What you're seeing here is sort of a starting point. So we have sort of shelling points that the market can work around that makes sense, and that you don't want liquidity to be spread too thin across too many different pools, right? But you also need enough coverage to be where people want across a yield curve. So we have a starting point, but the protocol is built to allow the community to build any of these redemption point pools they want over time, and start liquidity pools and fill in gaps and place their tokens into farming pools for reward during the, as we go. Well, not the farming so much, but they want to be able to create the liquidity pools anywhere they want. So it's about creating the right starting point and allowing the market to take things where it wants to go over time.
And so, yeah, just to be clear, these are just ones that you guys are incentivizing liquidity to go to, but anybody can create an HTT token at whatever day that they want, essentially, as long as it's within 5,555 days from whenever it is you're doing it.
So, you're muted, Don.
Yeah, sorry about that. I was just saying, yeah, you can't mint HTT 50,000. It's
Yeah.
you couldn't create a stake with that equivalent end date. Yeah, yeah, that's a good summary. We could jump into some of your questions though, cryptosloth, if you wanted to go there next.
Just real quick, have you guys decided what the pairing for the yield farm will be? Will they all be against Pulse, or what will be the other half of like the HTT 4000?
Yeah, these will all be against Hex, so HTT 3.5. Yeah, gotcha. And that'll create, the system is essentially benchmarked against, the Hex token, and also it'll be easier for users to kind of perform that amplified staking cycle where you can sell HTT for Hex and then restake. So yeah, we thought it was most natural to pair with Hex.
Yeah.
But anybody can create a pool, obviously, with any pairing they want, and with any redemption day they want.
Yep, that makes sense. Awesome.
Cryptosloth, you mentioned this, like how to think about redemption days, like your stake might end on day 5,000, but that doesn't necessarily mean you have to mint Hex Time Tokens that redeem on day 5,000. You do have some interesting options here. So again, I mentioned we're going to bucket this under kind of some advanced features. For most use cases, this probably isn't recommended. However, it is potentially a really powerful way to to get the most out of your stake. So the protocol is more general kind of than we've been implying, because we want to keep it as general as possible. But the general concept here to understand is that redemption day on your Hex Time Tokens that you mint can be set to any day where the Hex end stake proceeds is greater than 0. It does, however, mean you can only mint Hex Time Tokens up to the amount of the projected end stake proceeds and no more. So different redemption days result in different amounts of Hex Time Tokens that are mintable. But there actually is a wide range of days that you can choose from. With that being said, end stake day, if you match redemption day with end stake day, it's going to maximize the amount of Hex Time Tokens you can mint. So we recommend that approach just for the sake of maximizing the amount of time tokens you can mint. With that being said, we bucket this decision across 3 different kind of main options here. So that first one I just mentioned, this is the recommended case. Redemption day equals end stake day. Actually, let me go in order here. So this is a recommended case, and as I mentioned, the amount of Hex Time Tokens you can mint under this case is equivalent to the intrinsic value of the stake, so the principal plus rewards accrued to date, and it maximizes the amount of Hex Time Tokens. Scenario 2, which is more complicated, is you can set the redemption day to a day that falls after end stake day. And in this case, the amount of extractable Hex Time Tokens that you can, the amount of mintable Hex Time Tokens equals your intrinsic stake value like before. However, we have to lower that amount by the theoretical end stake penalty. Because again, the concept to grasp is that redemption day can be set any day where the end stake proceeds is greater than 0, which means you could, even after end stake proceeds, you'll find yourself where end stake proceeds could be greater than 0. So you should be able to mint Hex Time Tokens against that day. But again, we have to assume worst case scenario, basically, that suppose the user lost his private keys and he's not able to end stake on time. Users have to be confident, 100% confident that when redemption day arrives, the tokens are going to be there waiting for them, which is why we have to lower the amount of extractable HTTs by the maximal end stake amount depending on the day. So basically, the further redemption day is from end stake, the less the lower the amount of tokens you'll be able to mint. And eventually it drops to 0 because after 2 years, your stake is at 2 years after end stake, your stake is in 100% penalty. Your stake is worth 0. You're not allowed to mint any Hex Time Tokens. Therefore, if your redemption day is set to that far out after end stake. Does that scenario make sense, cryptosloth? Okay, yeah. I'll go to the last. Great. The last situation. This one's probably the most complicated, but potentially the most powerful. And there's a scenario where you can actually set the redemption day before end stake day. And this is interesting because now your Hex Time tokens are backed by the emergency end stake value of your stake. So again, you can emergency end stake, and you'll be guaranteed potentially, depending on where your stake's at, to have end stake proceeds more than 0. And so I could set my redemption day 1,000 days before end stake day, and the extractable amount of Hex Time tokens I can mint will be that intrinsic value minus that emergency end stake penalty, which we know to be essentially your principal, or sorry, the rewards earned in the first half of the life of the stake. Those are all penalized against you if you end stake. And so we're able to precisely determine, what's the, under a worst case scenario, what is the minimal amount of hex proceeds we might end up with if we end staked on this date. In that circumstance, we can set, we could set the redemption date of that date, and the system will allow you to mint hex time tokens. However, if you fail to return those hex time tokens, the system's going to EES you on redemption day, or the community is going to EES you when they go to redeem their hex time tokens. So that's a powerful strategy because, sometimes you might have, let's say you have an obscure stake like that ends on day 7,212. And maybe HTT 7000 is actually the liquid time token that you want to trade into, but your stake doesn't end on that day. So you could employ this strategy so that you can mint tokens that are actually liquid, and then sell into the liquid pool. And then, but again, you're subjecting yourself to potentially an EES by the community if you don't return those tokens. So there's an extra burden on the staker when they choose that route. But again, it could be a really powerful strategy in order to enter into a liquid pool.
That makes sense. So generally, if you wanted to keep things simple for yourself when making a new stake, find one of the HTT tokens that has decent amount of liquidity, or is that incentivized, that aligns somewhat with where you want to throw your stake out, and then choose that redemption day if you don't want to consider the other stuff. But if for some reason one of those alternate scenarios works out in your favor, just know where the risk lies and where you could potentially be penalized, or where you might be losing some value. This is actually really relevant for people who have HSIs that are already created that obviously didn't consider this because it didn't exist. So you'll probably have to kind of finagle like where you can get the most value out of your stake if this was something you were looking at.
Yeah, these concepts here, I think these are options for users that we're going to have to unpack over the course of months, because there's just going to be some really interesting, strategies you can do with this. But again, it's all going to be grounded in the Hex protocol. Like I think it's just a matter of staring at the protocol long enough to be certain about, this first point here. Redemption day can be set to where end stake proceeds are greater than 0. And there is a wide variety of days. You could end your stake across a wide variety of days, and your end stake proceeds are going to be greater than 0 in a lot of cases. And in a lot of cases, you're going to have a guaranteed amount. Even in EES, like you could know before you hit EES, you can know with certainty what your proceeds value is going to be, just by consulting the protocol. So again, there's some this is confusing. There's some confusing strategies here, but I think it's ultimately just a reflection of what's going on in the Hex protocol.
Yeah. Also, if it wasn't obvious for people watching, you can't use this with native stakes. This can only be used with HSI. So if you have your native stakes, just kind of like you couldn't make them into HSIs with Hedron, you're not going to be able to utilize this. So if you want to utilize this, you have to make HSIs first to be able to interact with the contract.
And all that's done through the Actuator protocol. You can just come to the Actuator and create just come with Hex, and you can do the rest right there.
Yeah, so you could take your existing HSI, or you could just go directly through the protocol, and the protocol will create the HSI. And yeah, like you mentioned at the beginning, CryptoSloth, it's kind of an underrated innovation, the HSI system, because we have transferable NFTs, and it established a critical kind of primitive or building block that we're just building on top of. So
It's kind of funny how the circle of tech is, where we go from a fungible token that you lock up, so then you lose liquidity for it. So it's like, okay, so then we're going to wrap that into an NFT. So now we can transfer it, but now it's not fungible again, yet we can transfer it. And now with this, we're going to take that non-fungible thing, we're going to put it in here, we're going to get something fungible out of it, so that we can get liquidity. It's like this fun. It's just like cycling through all the different properties to get what we want. It's pretty funny.
Right, but we're hopefully spiraling upward. So we go in cycles, but it's positive.
We're going up,
Right. That's that starting out underdeveloped and blunt, moving towards more developed and nuanced.
Yep. Yeah, you muted, RJ.
My bad. We could dig deeper into this redemption day topic because, again, it's really fascinating, and we've given the tools to, and like, so this chart is available in our Dapp. Any stake you have, there's like an advanced analytics you could perform. And in fact, do you mind if I share a bit about we could take this wherever you want, but I could share some of the Dapp really quick.
Yeah, please.
I just might need to share my screen in a new way here.
While he's calling that up, it might be worth knowing, we expect this to go, we're in public testnet right now. So all of you can go just play with public testnet. I'm sure we'll give that information. And
and I have all the links in the description for you guys. I have the site, the Dapp, and the white paper all in the description. So
great. Right, and we're looking forward to mainnet ideally in the first part of October. And farming will begin very quickly with.
Yeah, October 8th is the day we're pretty solidly landed on that day. So launch day.
You ready to bring it up?
Yeah, go ahead.
It's almost like you guys got some advice on when to do your media storm for launch.
Yeah, I wonder who helped us with that. We owe that person a lot of favors. So this is the Dapp. I'm in the stakes view here, and I just mentioned, there's some analytics you could perform on your stake. So I'm on testnet, and this table here shows my Actuator delegated hex stakes, and you have actions that you could perform. So you could, before you make any motion on your stake, you can kind of analyze different metrics. I don't know if it's worth getting into all these. I guess I'll just highlight a few. So the green chart highlights the projected intrinsic value of your stake through time. So it kind of gives you a sense of how many Hex Time Tokens will I be able to mint as the stake progresses. The yellow ball indicates the current amount of extractable Hex Time Tokens. And then there's some other things like we threw in the emergency end stake chart. What's my expected end stake value if I EES'd? So we give you a bunch of tools there, and then in order to create a stake, you'd go to new delegated stake, and then you can create a stake like any other stake. So I can give it my hex, and then I can select my end stake day. Notice that you get a few just preset options for which end stake day to choose, because at the moment on testnet, these are the only we have 3 liquid pools we've established on testnet: HTT 3000, 5000, and 7000. Therefore, we kind of want to encourage users to choose stakes that end on one of these 3 days so that they can mint the maximal amount of Hex Time Tokens. But if you choose, you could set any end stake day you want, like you would with any other stake. But you could choose the presets, submit, and then I don't know if you could see my doesn't look like you see my wallet, but I just signed a transaction to create the stake, and then momentarily the stake will show up in this table here. And then so there it goes, just showed up, and then from there you can there's under the actions tab you can extract Hex Time Tokens. And again, I can extract 100 Hex Time Tokens because I just created a stake with a principal of 100 hex, so I could extract the full value thus far. And then as the stake progresses, my rewards, my interest in my stake is going to increase, and each day I can mint new tokens, new Hex Time Tokens against my hex. So that's the process of creating Hex Time Tokens. You can jump over to pools, and you could swap in one of these PulseX pools. We created a front end which can interact with the PulseX contracts. And then lastly, if you want to look to acquire the Actuator token, you could farm the Actuator token by going to earn, and then farms here, and then you could deposit your LP tokens into one of these farms and just earn Hex Time Tokens every day. And as I mentioned, 75% of the tokens are going to go to these farmers. So
quick question. Let's say you just you just stake on here, but you don't mint any HTT tokens. Can you move that HSI off of that wallet? Or is it
yes.
Okay.
Yeah, in fact, I could demonstrate that. So this guy right here, this first one, I haven't extracted any Hex Time tokens.
Mhm.
However, it's delegated to the Actuator protocol. If I wanted to pull it out of the Actuator protocol, I would go to revoke delegation and submit that. And then, upon signing that, which again, you can't see my wallet, but I just signed that transaction, and then it'll show up down here. So we created also a table for your HSIs, and these are, these HSIs would show up on the ICOSA Dapp, and there it goes. So now you could, it's a tokenized HSI. I could send it to you. You can send it back to me. And the only reason I'm able to do that is because, like you said, I haven't extracted any tokens against it, so it's not collateralized. Therefore, I'm free to transfer.
And to reinforce the point, let's say you had extracted HTTs and you used them and deployed them, and 2 months later you decided, I'd like to do something with the HTT and transfer it. Well, then you can go to the open market. You can buy the number of HTTs needed to clear your obligation and send those in and clear out that obligation, and then extract your HTT or your HSI.
Yep. Perfect. So if you have anything minted against it, it can't be moved. But once it's you're extracted to 0, then it's fully removable, just like normal.
Yeah.
But it has to be delegated. You have to delegate it first.
Correct. Yeah. Like we have to be, in order to enforce the accounting in the system, we need to make sure users can't misbehave.
Yeah. Okay.
So yeah.
Awesome.
Yeah. Good. I don't know, Bill, is there any other high level topic we wanted to hit? I think we covered a lot there.
A lot of stuff for sure.
Yeah, I think that was an info pack stream. I like it. That was good.
Yeah. I guess I could just, one other concept we can hit on. And by the way, these slides are publicly available that I've been running through. Just general types of users who might find the system useful, or different use cases. So for delegated hex stakes, like we said, you get instant liquidity. Even if you don't want to use the system right away, you can, maybe a year from now, you may need to maybe you want to use it. So you preserve future optionality by, creating an HSI. You can increase your T-share exposure by, selling your Hex Time tokens that you minted for more Hex and then restaking. It could be a regular income stream for your stake if you choose, because you can mint Hex Time tokens for each day as you accrue interest. You can avoid EES. Hex Time tokens enables fixed returns in Hex, eliminate fixed returns without that counterparty credit risk or liquidation risk, and then you're going to see a rate of return that as the price as Hex Time tokens approach redemption, you're going to see price appreciation in addition to the price appreciation of Hex. So you're going to see kind of like that leverage price appreciation. And then, you could participate in the upside of Hex while retaining liquidity. So, users who aren't sophisticated enough to stake, maybe they're out there, but you do want to, participate in this, this system of Hex staking. Hex Time tokens are kind of an indirect exposure to Hex staking. And then we mentioned these curve strategies. And then, maybe some, like we've talked about these laddered portfolios, maybe one part of the ladder you're bullish on, one part you're bearish on. You can implement that strategy through these Hex Time tokens by doing what's called these curve trades. So just, just kind of want to run through maybe people who would find the system useful. So, the more diverse the set of users, the more efficiency, the deeper liquidity. So we just wanted to highlight that.
There's a ton of different ways, scenarios where you could use this protocol, not just, hey, I just want to get some liquidity out of my stake, although that is a really good one. 2 questions really quickly. First one, is eHex usable or just pHex?
Just pHex. We aren't, eliminating the option of, deploying this project on Ethereum. We in general, we don't love what we're seeing on that side in terms of direction. Obviously the system's just going to be way more usable in a low fee environment. But it's not off the table. We kind of want to see how things evolve here. I don't know, Bill, if you had anything to add there.
Yeah, that's right. I mean, we start like anything. We want to start where the mainstream is, make sure that we develop, understand how it's working, and let that go forward. But we could certainly migrate it as well to eHex if that time makes sense. We'll see where it goes.
Yeah, unfortunately, a lot of the functions would be pretty cost prohibitive over Ethereum, especially towards the bull market, and especially on the liquidity providing things. Trying to get liquidity in when those adding and removing liquidity things start to cost like $200. It's like, okay, like what are we like?
That's right.
It's not a problem right now, but it's always something when you're building on Ethereum you have to keep in the back of your head, because that can happen again, and it probably will happen again.
That's right. It showcases the importance and value of Pulse Chain. So that's
Right.
why we're going to get it.
Yeah. Yeah. Thank goodness for Pulse Chain. So.
Yeah. And then here's another one from Tin Top. Counterparty risk. What's the incentive to push the end stake button if all the gains were already extracted?
You're not allowed to push end stake if you've extracted any Hex Time tokens. So the protocol is going to enforce limitations on what you can do with your stake. Even if you minted just one Hex Time token, you're not allowed to end stake because other users have claim on that underlying stake. So yeah, so we put limitations on what you could do with your stake, depending on if you've minted those Hex Time tokens or not.
It's kind of similar to with HSIs, where if you borrow Hedron against your stake, it locks you out of certain features of that Hex stake because of what
Exactly.
you've done. But once the redemption day comes along, then you are able to end stake it.
Exactly. Yeah, and you're able to collect your proceeds like normal, minus the amount of Hex Time tokens you've already minted.
And it's worth mentioning because maybe this is part of what he's bringing up here, Tin Top. I mean, what is the case if we get to end stake and the user who controls the stake isn't going to do an ending of the stake at all? There's an incentive system in the protocol to make sure that those hex are in fact available. And the community can actually earn some money and cover its gas fees by being incentivized to do the end staking where it's not being done by a holder.
And that's another one of the benefits of having it all in HSI, because the NFT owns the stake technically, and so if it's in the Actuator protocol, I guess technically the Actuator protocol owns the NFT, even though it's attached to that specific wallet. So then you can allow other people to run those functions through the
exactly. Yeah, not possible apart from the Hex stake instance wrapper.
Yeah. Oh, well, I guess you guys. Well, never mind. It was a question about whenever we get HMIs, will it be able to be plugged in or not? But we don't really have any detail on that, so you guys can't really plan for it. So it's not.
Yeah, I mean, just one comment though. We know based on I guess publicly available information is that the Hedron 1.0, the HSI 1.0s, they'll be compatible in some respect, with the new system, and our system creates HSI 1.0.
And technically, the 1.0 never goes away. Like, it's just a different contract. So you can still use the 1.0 contract for your stuff. It's actually not and for your guys' purposes, obviously it has everything you need to do what you need. So the migration of contracts in the Hedron Icosa ecosystem is not important, really, actually, for you guys too much.
Yeah, we'll see. We'll see if there are any limitations, if at all. But we expect at a base level, we expect a reasonable degree of compatibility. But nobody's in. I'm not inside Alex's head there. I don't know what's exactly is in the pipe. So we'll see.
Same. Awesome, guys. Well, I'm excited for this to come out. Anything else you guys want to discuss before we start to wind it down?
No, other than just, I guess I could tell you where to find us. We're, like I said, the Forge has been helpful in just kind of incubating us. And we've got a lot of helpful feedback and also just direction there in our project launch. Our scheduled launch date is October 8th, and then farming will begin the following day on the 9th. And those will both happen at midnight UTC is the plan. And yeah, you could find us at actuator.finance, and then you could find our relevant audits as well as just links to the docs, as well as any informational videos in our Telegram.
And I just put a link to the Forge, the Actuator project on the Forge. So you guys go over there, leave a review, give them a score, get the engagement up. Yeah. And then how about Twitter? Where can we find you on Twitter and everything? Or you guys?
Sure. Yeah. Our company Actuator Finance is at Actuator Finance, and then I'm RJX or 21 RJX. And then my co-founder here is, I think you're just at, you might be at B3 works right now. We need to get that resolved. But
you can see B3 works and C3 works. You'll recognize it, but I'm normally using C3 works.
yeah. So
there's the link to the official Twitter for everybody. Awesome.
Yeah.
All right. Well, guys, thank you so much for coming on. I had a ton of fun. This hour and a half flew by, you know?
Yeah. It's a good time. Thanks.
All right. Thank you.
Yeah, no problem. We'll be in touch, and maybe a little bit after launch when we get some data coming through, we'll bring you back on to kind of review how things are going and, you know, see how the market responds to this new utility.
Looking forward to it.
Yeah. Great.
All right, everybody in the chat, as always, thank you so much for coming live. Thank you to all 26 of you who are still here watching us after this hour and a half. I will be back eventually. You'll know when I go live again. But until then, peace out.